Balance sheet. Financial statement that reports the financial position of a company by presenting assets, liabilities, and equity. The balance sheet is presented at a fixed date in time, such as the year ended 12/31/2100. This would be a calendar year. It presents accumulated activity at a very specific point in time. That is why it looks like a snapshot sometimes. The balance sheet is so fundamental to accounting. Where do we even start? It contains assets, liabilities, and shareholders' equity. It also links the income statement to equity so that balancing transactions, everything is recorded. Balance sheet represents the accounting equation in the form of assets, liabilities, and equity. Assets, we're going to have things like cash, accounts receivable, which is when we bill out clients. Liabilities is going to be money we owe, such as accounts payable. Those are bills that we might owe, or might also be things like long-term debts. Equity. This is going to loosely correspond to value. In the equity section, also represented will be common stock, how the company was funded, and retained earnings, which connects the income statement to the balance sheet. That's how they connect. Assets equals liability plus equity. Our very famous equation. Just take a moment. Balance sheet usually is vertical and always balances. So we may have something like assets of 1,000, liabilities of 100, and equity of 900. In this particular scenario, we could even think of this as our own home. We have a home worth 1,000. We have a mortgage, a debt of 100, and we have our equity. Yay, equity of 900. A very, very basic model. This being a snapshot, snap at a point in time, 12/31/2100, the future. But let's also introduce how the income statement or profit and loss can interact. The income statement is going to have revenue minus expense to either equal a profit or a loss. Now this profit can also be referred to as net income or net loss, let's say. Once this is done by technical methodology, this will come up into equity either increasing equity retained earnings or decreasing. This will be equity, more specifically retained earnings. Income statement for this is a period of a year activity. Balance sheet is going to be a snapshot. Why might a person care about the balance sheet when we look at just the income? Well, it's very important to understand how the company got funded, where things are coming from. So here, assets, we have a building right now, right? And here we have debts. And here we have essentially a value. But this will also include common stock, retained earnings, liabilities, accounts payable, AR, and always cash. You will see at the point in time how much cash does the business have, what kind of debts does the business have, and what else is going on in the form of investments, retained earnings, income statement activity, a little bit more of a complex analysis. This is just a bare bones introduction to the balance sheet, knowing that it's a snapshot in time showing assets, liabilities, and equity. Memorize each account and try and understand what the word means, how it might apply to you in real life. Assets, liabilities, and equity also have more complicated accounts that aren't worth going into right now. If you are studying T accounts, which shows how things increase and decrease in the accounting system, if you're going to be a bookkeeper, technical accountant, want to make your adjusted journal entries, debits, credits, assets are going to increase with the debit, and everything else is opposite. Decrease with the credit, all just to be memorized. Liabilities increase with the credit, equity increases with the credit. Coming to retained earnings, right here, equity account increases, decreases like this. As far as revenue, going to increase with the credit, and expense increase with a debit. That's the back end of the accounting system. Some people won't need to use that at all. This has been accountingplay.com. Thank you.